life lesson. Failure is a bitch of a teacher, but a really good one, right? I was this cocky lawyer. I wanted to start a $50 million fund to do a whole real estate development. My big flaw was trying to do too many things for too many people, too big, too fast, without help. I failed to get it off the ground.
Well, it's those experiences that actually lead you to teach others and to be the person you are today, to be able to put these deals together and know what the pitfalls are.
And I learned a million lessons. And one of the biggest lessons that I learned, actually, which is not to abandon myself. We spend so much energy and so much of ourselves trying to bend ourselves and contort ourselves into whatever societal expectations are.
We all have our own path. And the only one you're competing against is yourself. Having a passion for what you do or being really good at it, what's more important?
In life, there's a blueprint for everything. There's no need to start over. Hear from industry leaders, those at the top of their fitness journey, and real estate gurus. They tell you exactly how they did it. All you have to do is listen, learn, and execute. This is The Blueprint with Brad Rice.
All right, guys, welcome back to another edition of The Blueprint. And today I am super excited to bring on a new guest, something that you guys have not heard about before. So we're going to get into some really interesting chat here. But Bethany LaFlamme has joined us. I hope I said that right.
You did, yes.
Okay, good. Bethany is an SEC attorney, but not just any SEC attorney. She does real estate investing. She's a public speaker, and she specializes in helping syndicators practice safe SEC, which is an interesting thing to say, and scale their businesses at the same time. So she's a managing partner of Premier Law Group, and she focuses on private securities for real estate investments. She also leads retreats that are focused on wealth building. And she's a mother and an advocate for holistic abundance. And Bethany also loves to inspire others to create lasting legacies. She's got some pretty cool stuff coming out, including a book that we're going to talk about. But this is going to be an interesting subject because those of you that are in real estate, whether you're investing, flipping, buying for yourself, single family, multifamily, whatever it is, knowing about syndicating money and getting into bigger deals is something that isn't really taught. And so let's get into it today. Bethany, I want to thank you for coming in.
Thanks for having me.
Yeah, absolutely. So what I'd love to start with is I was poking around your Instagram, and we talked for a second about this before the cameras came on. But, everybody's got their own journey, right? And what you think about when you're a kid, about, what your adulthood will look like, when you're going to have kids, when you're going to get married and all those sorts of things. Doesn't always happen that way. And with social media, we kind of wind up in this trap. This is what I feel like it's compounded with social media for youth. It's like pressure. You see friends and they're flexing and, is it real? Is it not real? And they're doing things at an early age and they talk about all the money they're making, or maybe they're flexing their cars, and you feel like you're falling behind. And we did that to some extent before social media, but now it's just compounded. So you did this post, Chris. You want to bring up that second one up there, and you kind of did your timeline.
Yeah.
And I thought that was really interesting. So I thought maybe we start there.
Yeah.
Like just kind of your history of how you got to where you are now, because you're doing some amazing things now. So
Thank you. This post was sort of born of I'm older now, and it was sort of a try to keep up. And I at first felt like, gosh, I'm too old to get into this social media garbage. Like, I'm 51, and I felt so behind trying to catch up to all this social media stuff, you know. And I was like, and I have these women coming to me, younger and older. Older women are like, oh my God, I'm so glad you're doing this. I felt like I was behind too. And younger women feeling like I have all this pressure. And so I thought, you know what, let's just cut the bullshit. Let's talk about how this really goes.
Yeah.
And, we get delayed or whatever. It's not really a delay. We're on our own time. And as long as we're happy with our journey, then kind of who cares? Yeah. There's this, I'm actually in the middle right now of reading a book by Glennon Doyle called Untamed. And she talks a lot in the book about how we spend so much energy and so much of ourselves trying to bend ourselves and contort ourselves into whatever societal expectations are. And the truth is that's never a winning proposition, because you're going to still piss some people off and you're still going to make some people happy. And if you abandon yourself, that is the worst kind of betrayal. You should actually live to disappoint everybody else, as long as you don't disappoint yourself.
Well, here, by the way, I follow Gary Vee. I have since the very beginning. His message is it's on repeat, right? Yeah. It doesn't matter the age. You can don't worry about other people. Here's the reality of it, and I think this will resonate with you, and it should resonate with everybody. Nobody's thinking about you.
That's right.
That's the bottom line.
Yeah.
Nobody cares. Nobody's thinking about you. They're all thinking about themselves.
Yeah.
So when you're on social media, or when you're talking to people, or when you're doing presenting, or when you have your communities, it really should be about them, right? When you're doing that, you should be thinking about them. Like I'm thinking about you right now today. We're talking about you. We're not talking about me. And when you leave here, you would be so far from reality if you thought that I'm going to continue to think about you all day long, right?
Yeah.
And and I'm not saying that to be mean. It's just reality. And so we all have our own path. And the only one you're competing against is yourself. Right. So I loved this post because you literally went from like you graduated school at 26, then you became an attorney. And then that was the same year, which is great, right? Then you started, what did you start? You started your own law firm after that at 28 years old, which is incredible.
But I wouldn't recommend it.
Because?
I was a baby lawyer. I just got out of law school 2 years prior. I had no clients. I had no mentors. I had no partners. I tried to do everything by myself because I'm a strong, independent woman and I can do it myself, damn it. That's an exhausting way to live. Yeah.
So that's something somebody could learn from. Right?
Yeah.
Don't feel pressured to do that so early on. You need the experience.
Yeah.
Then you got married, you had a baby, and then that's funny. You said then got divorced. Okay,
that's
so that's all in there.
Yeah.
Then you left to start a fund.
Yeah.
So let's pause there for a minute.
Yeah. So the greatest failure of my life and the biggest life lesson. Failure is a bitch of a teacher, but a really good one. Yeah. Right. And I'm sorry if you have to edit that part out.
No editing.
I failed hard. I was this cocky lawyer. Imagine a lawyer being cocky. Could you imagine?
Yeah, no, not at all.
And I thought, I've done a bunch of these deals for clients. I've seen a million of these deals before. I can go set up my own fund, and not just, let me just go start a little fund. I wanted to start a $50 million fund to do a whole real estate development, to incubate tech companies that were founded by women and underrepresented founders. Like, my heart was in the right place, and the law was in the right place. I had this brilliant, complicated structure, legally sound, couldn't explain it to anybody.
Oh.
Right. And so investors were like, I can't give
It's
you money
too
if I don't
complex.
understand. Right. And it was, my big flaw was trying to do too many things for too many people, too big, too fast, without help. And so I tried and I contorted and I did all the things, and I failed to get it off the ground. And I learned so many lessons there, right?
So when you say you failed to get off the ground, you didn't even get an investor in it? Like not one?
Well, I had some partners put in money who are super pissed that I wasn't able to finish and get it off the ground.
Okay.
But no, we never even brought in investors into the fund really, which is a blessing.
Yeah.
Right? That's a blessing. If I had raised $50 million and then failed, that would have been worse. So, could have been worse. And I learned a million lessons. And one of the biggest lessons that I learned actually was exactly what we just talked about, which is not to abandon myself. But the other lesson that I learned that I wrote a whole book about is how you can't do everything yourself as good as you think you are and as strong as you think you are and, as much as you think you have to, because we're all entrepreneurs, right? We want to roll up our sleeves and get in there and do the thing, right?
Yep.
You got to hustle for a while and do that, but
it's those experiences that actually lead you to teach others and to be the person you are today, to be able to put these deals together and know what the pitfalls are. But you mentioned your book, so let's talk about it. The Power of OPE, which is other people's everything. So, of course, I think about OPP and the song and all that.
Me too. Every time. It's in the book. I actually write it in the book. I'm like, now it's in your head.
Yeah, it just is. But, tell us that. I mean, what is the message of that book?
the message of that book, we've all heard of OPM, right? Everybody, at least in
Yeah.
our sphere, has heard of OPM, other people's money. And I kind of flipped that around a little bit because that's not enough. And now being a securities lawyer, I realize it's actually dangerous if that's all you do, right? So other people's everything is really give yourself permission to figure out, I call it your lane. What's your lane? What's your passion, your unique gifts, power, whatever. Figure out what that is, which is an exercise to go dig deep and figure out, okay, what is it that I really am good at and what lights me up both. I'm really good at it and it lights me up. Figure out what that is and then get everybody else around you to do anything that's not that.
Yeah.
And that sounds a little entitled, like I'm only going to do what I want to do. And you got to earn the right to do that, right? You have to put in the reps to get to that point to do that. And you actually have to find really good other people. But what I figured out is your lane is decidedly different than my lane,
Sure.
right? And so there's something that you love to do that I suck at. I guarantee it, right?
Mm-hmm.
And so it's like, hey, I can let you live your bliss by doing a thing that I don't want to do, and you can do the same for me, and you're one of my OPs.
That's right.
You're one of my OPs. And the biggest part of that is, one, is figure out what you want to do, but two is let yourself do it.
Yeah.
You know, we've had all these shoulds around us, and that's the hardest part, actually, is letting go.
Yeah, that's right. And, it's funny because I have that exact relationship with my business partner, my mortgage company. She loves to get in and do the details, kind of make things happen. And I love being the visionary and I love the ideas and kind of broad strokes. And so we make a really good ham and eggs.
Yeah.
But, between the two, having a passion for what you do or being really good at it, what's more important?
My advice for someone selling their home: number 1, do it yourself and save. Number 2, use HomePie.
HomePie makes it easy to buy or sell without an agent. I can list a home in minutes and start receiving offers right away from buyers.
When we discovered that we didn't have to lose $40,000 in agent commission just to upsize to a larger home, it was an obvious choice.
List your home for free at homepie.com. Keep your piece of the pie.
Having a passion for it. You can learn skills. You can't really learn passion. It's not enough, though. And I don't want, I tell my daughter this all the time. I want you to find your passion. I do. And I want you to live in that passion. But you got to figure out a way to give to other people and solve their problems if you want to make money at it. Otherwise, it's just a hobby. Right.
So I kind of feel I feel the opposite of that.
Yeah.
I feel like it's really important to do what you're really good at. And
fair.
if you're not passionate about it, that's okay. Be really good at it. Be the best. Do really well at it, and then do whatever the hell you want outside of that.
Yeah.
So,
I think you need both.
because people will
though.
pay. Yeah, if you can. If you're lucky enough to find something that you're really passionate about and you're also really good at it, like maybe you love singing, but you suck at it. And you have a passion for it, and you sing in the shower every day, and you're like, I'm awesome. But nobody thinks you are? What good is that?
Fair.
But
That's fair.
If let's say you're really great at social media, not in front of the camera, behind the camera, whatever it is, and people will pay you to do that because you're really good at it. But you don't really like it that much, but you're really good at it. You're going to do well.
Yeah.
And then you do whatever you want with your other time.
No, you're right though, and I think probably we're at different ends of the spectrum, right? I kind of skipped ahead, and that's a really good point that you bring up, because then I talk to these younger people and they think they just get to skip ahead
Right.
to where I am, and you're right, yours comes first. Actually,
Yeah.
You have to put in the reps, you got to work, and you got to hustle. And I talk a lot about, I do not buy this bullshit hustle culture that we've been fed,
Mm-hmm.
but I do believe you have to hustle. You just need to hustle at shit that matters.
Yeah.
Either that makes you money, it gives you your passion, or both, but you have to hustle at stuff that matters, not this I'm busier than everybody else and that makes me more important or whatever. Ugh, it's boring.
Yeah.
Nobody wants to hear it.
Yeah, and the other part of this, kind of the next step, is the stick-to-itness.
Mm-hmm.
Because
Oh, yeah.
too many people start something, want immediate gratification, and then stop. And we may be really good examples of that, to be honest with you. So I started this podcast a couple of months ago. I had one before, virtual podcast. Not a lot of traction, but we talk to great people. We make good relationships. It has its benefits. And then I decided, you know what? I'm going to go all in on a different podcast, in person, really building deeper relationships, really getting into, more of a benefit for listeners. And it's a matter of doing reps. Like even though it's only been a few months, I've become so much better at it just by continuing to do it. Now, do I have a ton of viewers? No, but I'm getting more and more, and I see the downloads, and I just have to be consistent. And I know this may take a year. It may take 2, it may take 3, it may take 5. But if you stick to it, then you'll get to the end. If you don't, you'll never get there. That's right. So, that's really important. So this is a really good, kind of segue back to this post, because, you started this fund, and then, like you said, it failed, right? And so then you started your current law firm.
I joined Mauricio Raoult, my now former law partner as of last week, and I joined him to help him because he was struggling with his health, and he's been out, I'm not disclosing anything he hasn't said publicly. He was struggling with his health, and he was looking for someone to help him not be the single point of failure in his what otherwise would have been thriving practice until he got sick. And I was licking my wounds trying to figure out what next, right? And I was like, look, I'll help you for a little while because this kind of stuff is easy for me, but I'm not going to stay. I'm done with law. I hate it. I'm over it. I got to figure out what I'm going to do next.
Okay.
Right? And he was like, whatever, I don't care. Just help me. I don't want to hear about your problems. So I started working in the law firm with him, just helping, and I met some of the clients in this space, and it was different than my practice before. My practice before, I was dealing with venture capital. I was dealing with large publicly traded companies. I was dealing with Silicon Valley bros.
Okay.
And I was treated like the help.
And that's a real thing.
It is a real thing. And they treat their lawyers, especially young women lawyers, like the help. Mm-hmm. And I was like, I have so much more to offer you. I more than just ascribe to do documents. I'm good at the law.
Right.
But I'm not really that passionate about it. But I was good at it, so I did it because it made me money.
There you go.
But that's not my superpower, actually. It's a thing I'm good at, and it's a service I can provide. But my superpower is actually, you tell me what your goals are, what your passions are, what you're good at, and I can help you build a scalable business around that.
That's a great superpower.
I didn't know it at the time, but I was like, I have all these ideas and nobody wants to hear them, right? And so I started to meet Mauricio's clients, real estate investors. Mm-hmm. We are 99% of our clients are real estate investors, active real estate investors. We say syndicators. That's just a fancy word for you're active in real estate investing, right? And you raise money. These are W-2 people just trying to build a legacy for their families. They're people that roll up their sleeves and get dirty, and they want partners. They valued the advice. They did not treat me like the help. Mm-hmm. They looked at me almost like I was a savior for them in some cases,
guide.
Which is great for big ego, right? Mm-hmm. I don't really have a big ego, but it feels nice,
Sure.
And I was like, these people I like. They don't suck. It only sucked because the people I was working with sucked, right? And so I was like, this I can do. And Mauricio's great. Run the firm.
Okay.
And I'm like, okay, that's
Got
fine.
it.
So fast forward 8 years later, 6 years later, whatever it was. And I just bought him out last week.
Okay.
And so
congratulations.
Thank you. And now I'm like blowing this out to like, how can I help more people do more things that are meaningful to them?
Okay. So the firm practices, or you practice, real estate and syndication?
Just syndication. So just securities law. So what we do is we help, I say practice safe sec, because our clients are all raising money from passive investors. We make sure that they do that safely. So they're scaling their business, and we make sure that they can do it in a safe way.
Okay, but it is tied into real estate. Okay,
yes.
So you're not doing syndications for other types of investments.
Not currently, no.
Okay, got it.
Yeah.
Well, that's a great field to be in, and I'd like to, for those people who don't know what a syndication is, what is a syndication?
Its very simplest explanation is a group of people that get together to buy something, anything. In my case, it's real estate. And some people put in money, some people put in work or sweat equity. They get together, and that's a syndication to go buy something. Somebody's passive, somebody's active. Where I get involved is when there are passive people, and that's when the Securities and Exchange Commission starts to get interested because you're selling securities if people are passive.
Yep.
So that's the definition of a security is really there's somebody who puts in cash that's passive and it's relying on your efforts to generate a return. That's a security.
And what's the difference between a limited and a general partner?
So a limited partner is their liability is supposed to be limited. They don't have a say. They're not actively involved. They are passive. And a general partner, and we don't really use those specific structures anymore, but it's the language has stuck.
Okay.
But it's really passive and active, or certain classes of membership in an LLC. But for GP purposes, that's the person that's making the decisions on behalf of the investment, doing all the work, and then generating that return. And in exchange, they get a cut of the profit as well.
So tell us a little bit about the general structure of a syndication as it pertains to real estate. So I'm an investor in Rich's fund, who I assume you may have helped him out with this, or
Yeah.
maybe okay.
Yeah.
And so he hasn't closed the fund yet; it's still open, although I think it's ready to close any time now.
Yeah.
This is his first boutique hotel fund.
Yeah.
And I'm one of those passive investors, right? There's a preferred rate of return. There's a recapitalization. There's an exit. So for people that don't know what this is all about, give us kind of your typical structure of a syndication.
Okay. So Rich's is a fund, and it can be a fund or it can be a single asset syndication. So Rich's, it's a fund because he's got multiple boutique hotels within that fund. You can also do the same thing, same law, with a single asset, which is a little simpler to explain. So I can start with the single asset. So let's say he bought one hotel, right? And what happens is he creates an LLC that ends up being, we call it a syndication entity, but it's your borrower and it's your property owner is an LLC. You set that up in the state. He's got one in California, so it's California, let's say, right? And we create two classes of membership within that LLC, Class A and Class B usually. We call the investors like you're a Class A member. You're passive. You put in your money. You've got no liability other than the money you put in. You're not on the hook for doing any of the work. You're not on the hook if things go sideways, other than you could lose your money, right? You don't get to vote. Very limited circumstances that you would get to vote. And then Class B members is Rich, right? And his company. It's really his LLC is a Class B member. The Class B member owns we call it a promote or a carried interest, but a profit interest split with those investors, right? The investors could have their interests split up in more than one way, but one typical way is like you're seeing it. There's a preferred rate of return.
So explain what that is.
So a preferred rate of return is just some predetermined return on your investment. So if you put in $100,000 and it's an 8% preferred return, you get $8,000 a year first before Rich's team gets anything.
And so the clarification there is it's first.
Yeah.
It's not guaranteed.
Thank you for saying that. Thank you. That's what I always tell people. You cannot guarantee, even if it's a preferred return, the only guarantee it is if there's extra money, you get yours first.
That's right.
That's the only guarantee. Thank you for saying that. And then sometimes they have an equity split on top of that. So you get your 8% preferred return. And then there's some profit left over, and you would get, as an investor whole class, as a class, 80% of that, and Rich's team would get 20%. That's his benefit for doing all the work.
Right.
Now sometimes there's
Plus they can get a
fees
management fee and some other
there's some
things.
fees
Right.
on top of that for keeping the lights on and that kind of thing.
Right.
And before anybody gets like, what fees? Most syndications, there's fees. And you want, by the way, you want the operators to get fees.
You
need
want them to be motivated.
incentivized. Yes,
Yep.
exactly. So I have investors complain like, well, they're feeing this thing to death. And there's a balance.
Yeah,
right?
for sure. And so along with that, because I think that people find real estate investing not only interesting, but an end game, regardless of where they earn their money.
Yeah.
And so that was kind of the exercise I went through when I was in college and I was trying to decide what I wanted to do for a living. I was kind of in and around real estate growing up. My dad was a general contractor and developer, so I was always on his job sites and big buildings and all this and that. And so I kind of got this passion for real estate. And then as I was trying to figure out what I wanted to do, it seemed like everybody that made money, whether they were a big actor or, in some business or whatever, ultimately their money wound up in real estate. So I'm like, I'm just going to cut out the middleman. I'll just learn about real estate and get involved. So I got into the mortgage side of things. That was my thing. But, being that this is something that a lot of people have an interest in, that if you're on, in your social feeds, you're seeing things about real estate, mostly, at least in my feed. I think that there is a real interest here on not only the structure of syndication, but the investment side of it. Mm-hmm. And so if somebody does have money and they are hesitant or don't want to invest on their own or they're not comfortable with it, it's a great way to get into real estate without the management side of it and still get the benefits. Yeah. So the benefits, to kind of walk through that with you, are potentially, depending on the deal, a preferred rate of return. So you get some sort of guaranteed rate of return, like putting your money in the bank. I said guaranteed, but I'm saying it's guaranteed if the money's there, right? And then at some point, you hope to have an asset that's appreciating or that has been rehabilitated or shored up in some way where it's producing additional income that makes it worth more. And then recapitalization would be the next step. Can you tell us about that?
Yeah, so there are a couple ways to make money, right, on the real estate. There's the cash flow, which is, let's say for multifamily or whatever, rents. Cash flow every month. If there's excess cash flow above the operating cost, you share that as a profit. And then there's the appreciation, which is just increased value over time. And the recapitalization is kind of an exciting way to get some cash out and minimize some of that risk. So usually recapitalization means you're going to refinance, right, which is the typical way, and then or you bring in different money from somewhere else,
restructure
to cash out,
the debt,
right? But the most common way is really refinancing it and getting either a lower rate or getting some cash out against the additional value, whatever that is. But what that does is it starts to reduce your risk as an investor, and you may still be in it. May still be getting a return. You may still be. It depends on the structure of the deal because it can be structured, infinite ways, right? But so let's say I put in $100,000 into a deal, and then there's maybe a year and a half, 2 years later, whatever, where there's a refinance, and I get $50,000 back. Not only have $50,000 at risk, but I still have my ownership interest. So I'm still getting a share of the profits. I might not be getting the same preferred rate of return because I'm only getting now paid on $50,000 instead of $100,000. But if there's an equity split, I'm still getting my same equity split that I was, but I only have $50,000 at risk now.
Yeah, that's right. And so you've got basically now two different ways of earning on your investment, right? We talked about the preferred rate. We talked about the recapitalization, so that's getting some. So now you can play with the house's money, right? In essence, or take that money and reinvest it elsewhere, or maybe there's an opportunity to leave it in there and increase your stake. And then there's the third, which is the exit, right? Yeah. And so, talk to us about that.
So the exit is usually the exit is a sale of the property. Not always, but it's usually the sale of the property. So the operator says, all right, we've owned it for our 5 to 7 years that we thought. We've increased the value enough. Now we're going to go ahead and sell it to somebody else. And we're going to share the profit of that with you, the investors, after we pay you anything that we're behind paying you on a pref, if that's the case, preferred return, your principal all the way back, and then we split in the profits usually. Yeah. And so usually you get some sort of upside. And so when you see, for example, someone pitching a deal where they are asking you to be passive and it says, hey, we're projecting you're going to get a 22% annualized return or a 19% that's actually high, but a 19% annualized return, and you're like, wait, it only has an 8% preferred return. What is that? How do you do that?
Yeah,
that's how.
That's
right. You get that appreciation and you get that paid out. And now you if that's an operator that's doing more deals and you got a really nice return, you're going to probably put it into their next deal.
That's right. And so just to go a little bit deeper into the exit side of things, because you said it's not always when you sell. The other way of doing that is a third investor or an alternative investor could come in. The general partner, I'll just refer to him that way. The operating partner stays involved in the deal, but the new general or the new limited partner pays off all the existing investors. Right. Either way, you're getting an exit as an investor, but that's the other way instead of a sale.
Yeah, one of the ways that some of our clients will do, especially if they think there's going to be a really huge appreciation or some big capital event, or if it's a fund where there's multiple properties and one might sell and others might not, is there's a function called a call option.
Okay.
And so the call option in this case would be the manager or the GP's right to buy out the investors without selling the property. And then if they do, you just have to tell them what the rules are. So, hey, I have a call option. I'm going to buy you out, after some period of time. And if I do, I'm going to give you this. I'm going to give you your preferred return caught up. I'm going to give you your principal back, and I'm going to give you enough cash that would get you to X% annualized return.
Yeah, a predetermined sale price, if you will.
And so, but then after that, as the GP or as the manager, I'm going to still own that asset.
Yeah.
Everybody wins there because the investor already knew what their return was going to be before they got out, and they agreed to it. So they're like, hey, I'm good. I got 20% or whatever it was. And then you still have an asset that is hopefully thrown off cash flow and is still an asset for your portfolio, but you own it free and clear of those investors.
Right. What's the typical shelf life for a syndication?
5 to 7 years is usually the typical. It could be longer if it's a development. If it's a fund, it might be a little bit longer, like 10 years. Because there's multiple assets.
And obviously, there's a lot of different ways to structure these, and you've probably seen more than most.
Yeah.
How many other people, attorneys, do the same thing you do?
I mean, I'm sure hundreds of them. In our space, it's a pretty small group. I mean, I know a handful of other securities lawyers specifically in real estate. There are a lot of big firms that do this kind of stuff. Those are almost never going to work for the typical real estate investor, mom and pop, because it's going to be $25,000, $35,000 to do it. So that's usually going to be a deal killer for these smaller operators. Like our average raise is probably like under $5 million for our client base.
And what does it cost to put together the paperwork for that?
It used to be $15,000 for compliance, although I did just roll out some cheaper options so that we could support our clients that are raising less money. So we have subscription models. We have lower, more technology-driven models that if somebody doesn't need quite as much hand-holding, if it's a smaller deal. So we really try to work with our clients to make sure. I'd rather them stay compliant. Because I think our industry as a whole needs to be a little bit more educated and a little bit more compliant, or else we're just getting a bad rap from Wall Street.
It sounds like you've really thought about the full spectrum of people that are starting in this. It's their first fund, and those have been in it for a while. Yeah. So you hear that, everybody? You have somebody you can contact to help you through this thing.
Yes, I do, and I want people to call me early.
Yeah.
And so I don't bill by the hour.
Yeah.
None of my attorneys bill by the hour. We do flat fee and we do subscriptions.
That's nice. What's the typical persona for somebody who's successful at raising money with a syndication and eventually having an exit? Are you a tech investor looking to shape the future of real estate? HomePie is the #1 for sale by owner marketplace, and we are revolutionizing the way homes are bought and sold. I'd love to hear from you. Just email invest@homepie.com and let's chat. Now back to the show.
Oh, I'm glad you asked that question. Nobody ever asks that. This is going to sound so much weirder or woo-woo for a lawyer, right? But I believe that there are only 3 elements to creating conscious wealth of this thing that I'm really passionate about, and I swear I'll answer your question. The 3 elements of conscious wealth: education, access to opportunity, and mindset. And mindset is by far the most important, because we all have access to free education all over the internet, right? I mean, you can go learn. Heck, I learned how to buy a boutique hotel before I met Rich by watching his YouTube channel.
Yeah, isn't that crazy?
Right? And so you can learn that for free. Now, I do think everybody should invest in their education as well. But if you can't yet, then you can learn for free. If you have the right mindset, you'll find there's opportunity everywhere, right? I mean, you go online. In our group that we're in right now, there's Rich Summers' 7-figure creator group. I'm going to give him a plug.
Good plug.
Yeah. There's opportunity within that group all over the place. That's how we ended up here today, right? The mindset is the most important piece. And so to answer your question, my most successful clients are the clients that have the mindset that they can be successful staying within the guardrails that I set for them in the law. It's the ones that think they have to skate outside the lines and do dangerous things that aren't actually going to be successful. So I know we're all like buck the rules entrepreneurs. There is a time and place for that. Yeah. And this is not it. Right.
Do you want to know what I looked for as an investor?
What?
Because I'm my own real estate investor. I own all sorts of residential, commercial property. I've been doing this for more than 30 years. I've flipped properties. I've bought, rehabbed. I'm adding ADUs to properties now. But there's a point at which you just don't have the bandwidth to do everything yourself. And unless you've established a company that is all about that investment, in doing that and building and acquiring. Doing it as an individual is just a really tough thing when you're running other businesses and doing other things and hosting podcasts and that sort of thing. And so you can't really be great at it. So if you're not going to be great at it, then you might as well have a great investment. What I was looking for was somebody who's super passionate about what they do, that had a really good business model, and I'll talk about that for a minute with the boutique hotels, and had a great team.
Yes.
Those were the three things I was looking at. And then, of course, what's the structure of the deal?
Yeah.
What does the paperwork look like and all that sort of
hands
thing?
down more important than the real estate.
Because the person that is the face is the driver, but they're not doing the actual work every day.
Yeah.
And so you want to make sure that you've interviewed and spoken with and interacted with the team, that you have confidence in them, and that there's not going to be turnover and setbacks and people that are not good at what they do and haven't done it before. And so in particular with Rich, and we keep saying Rich's first name, Rich Sommers, he has a team that's been managing his Airbnbs. He owns other properties. He owned multifamily. He already had owned a boutique hotel. And believe it or not, I had seen Rich on the Brad Lee podcast and or heard him. And he mentioned this boutique hotel. Well, first of all, when he was talking about boutique hotels, and I thought, I've never been passionate about Airbnb, primarily because I don't, as a consumer, I don't use Airbnb. Like it's just not something I like to be in a nice hotel and I like to be served on. So that just never resonated with me. And if it's something that it doesn't resonate with me, I just don't do it. And so, but this boutique hotel thing, I thought, well, that's Airbnb on steroids. Like these are short-term rentals, but there's a lot of them at once, and you manage them with one management company. You manage all these in one location, one property. I thought that's terrific. So that was the primary thing. And then I recognized this first hotel that he had. I had been by there. I had seen the area, and I thought, this is a really cool place. I want to come back and visit it. And when he brought it up, I'm like, what the heck? Like I knew the
universe
hotel.
is screaming at you. Yeah.
So I reached out to him. But then it was those three things that were really important to me, and he checked all the boxes. So I'm one of his bigger, investors in that fund. So
I structure deals for a living.
Yeah.
Okay. I've talked to hundreds and hundreds of operators, and when I invest, the team is the first, not the structure, it's the team.
Yeah, for sure.
Yeah.
That's a good lesson for everybody. So you also have this thing. If it's not a fuck yes, then it's a fuck no.
That's right.
What does that mean?
It is a way that I distill. We have opportunities flying at us all the time, right? And a lot of us as entrepreneurs, it's like shiny, shiny, and we don't focus on the thing that is going to get us to our ultimate goal. And I took a lot of time and effort and introspection to figure out my ultimate goal, pay a lot of money to coaches and whatever to figure out my ultimate goal. And so I invested in myself to do that. I can't unravel that whole investment by chasing every shiny object that might look cool for a minute without putting it through, I call it my abso-fucking-lutely analyzer.
Okay.
And that's a real thing. It's actually in the book, and I give it out to people what my analyzer looks like. And it's got to meet all these criteria, or at least most of these criteria, if I'm going to spend my time and energy and money to chase it.
I think people, if they knew about this, would be very interested in it. And I think you have a download of it.
I do,
right?
yeah.
Where can people find that?
So, where I'd like for them to find it is in the Conscious Capital Collective, which is the new community that I just released. So we can give people the link to that. But it is downloadable. If you actually DM me on Instagram, you'll get it.
Okay. That's a great DM.
Yeah.
I love it.
So people better be careful how they DM me, because you're just going to get a downloadable.
Hey, actually, you could get a lot of spam that gets this.
Yeah,
right?
they probably there might be a few people that have gotten it that were like, "What the hell is this?" Yeah,
I didn't ask for that. Tell us about the community. This is new.
The community is brand new, just this week, and it's called the Conscious Capital Collective, and it was born of. From the law firm, actually, we were trying to find a way to better serve our real estate investor clients. And it's a hub and a place for people to go get resources they need to scale their businesses, to get the tools that they need. I was like, what are the things that we keep sending people anyway? right?
Yeah.
Like here's how you check off what you need in your business plan or your pitch deck. And so it's all there, right? And then it's also a community where you can go meet other people, you can connect with people. I do live Q&As every single week in there. So you basically get an hour free legal advice if you show up. I interview people on Bubbles with Bethany, which is where I interviewed Rich, and I've interviewed like Mikey Taylor. We've had a few of the same people, right?
Yeah.
And just talk about how do you create conscious wealth. So that's in there. And it was born of that just to provide value. And I thought, everybody could benefit from these things.
Yeah.
Right. In the community. I really wanted a community, though, where you can go connect and find your other people.
So who's your ideal community member?
My ideal community member is a real estate investor at this point, right? A real estate investor who's looking to grow and scale by leveraging the other people in the community and who wants to do it right, legally, compliantly, but also who understands at this point that they should be hustling at things that matter to them and letting other people hustle at things that matter to them. And so getting out of the grind and hustle culture, and I tell the story in my book about Wayne Gretzky, arguably the greatest of all time hockey player, right?
Yeah.
And I read this story about him years and years and years ago. It didn't stick until recently, about how he was known to be kind of chill. That was probably a bad pun, but on the ice. So he would like kind of hold back, right? Let his teammates do their thing. He would be able to breathe and watch and think. And then he would figure out where he needed to be, hustle there, get in front of the puck, do what he needed to do, and then dial back. But he had energy to do that because he wasn't skating up and down the ice to showboat or show everybody how great or important he was. He knew when to turn it on and he knew when to turn it off and he knew when to let his other people do their thing. That is what this community is for. It is so you can be Wayne Gretzky. Be amazing when you need to be and then chill.
And that's a great lesson. I really like that. I mean, is there, from a perspective of what their goals are, is this for people that are looking to put together a syndication, that have been investing on their own and are ready to do that?
Both. Passives too.
Okay.
You can go in there actually and learn how to analyze a deal.
Okay.
You can go in there and I actually have tools.
And when
in
you
there.
say a deal, what do you mean? What kind
An
of deal?
investment. Well, right now it's all in real estate. Eventually we might, I'd like for this to really be a hub for everybody in Main Street. Though we can do coin operated laundry. I mean, the principles are the same.
Okay.
Right. But right now it's geared towards real estate investors. Any asset class doesn't matter. Passive investors can go and like, what should I be looking for in an operator? What should I be looking for in the PPM, the private placement memorandum, which is just this big scary document that tells you all the things that could go wrong with your investment. And somebody who's passively investing for the first time is like, it's 100 pages of legal. What?
Yeah. Give us the definition of a PPM.
It's a private placement memorandum. And when you're selling securities, like we talked about earlier, the SEC says, okay, if you're not going to publicly register your security, like Facebook or Microsoft or whatever, which most real estate investors are not going to do that, then you've got to find some exemption to registering. What that means is you need to give investors all of the risks and information that they need to intelligently decide if they should or shouldn't invest. That's what a PPM is. It's the risk disclosures.
Okay. And so why is it a couple hundred pages?
Because lawyers get really creative and clever and figure out ways to poke holes, right? But it's also not just the PPM. There's an operating agreement in there, which is basically the rules of how this business is going to be run after the money's in. So what are the rules that Rich has to follow when he's operating his business? You as an investor get to know that ahead of time because you are a member of that that company, so you're a member of that operating agreement. That is how you sign to become a member, right? Then there's an investor suitability questionnaire, which is really to protect the syndicator, Rich, in this example, right? It's to protect him. He needs to know about his investors to make sure he's taking money from people that can afford to give it, that are sophisticated enough to give it, and that qualify as investors in this deal so that he can still take that exemption from registering the security.
Does that mean that investors in syndications have to be accredited?
Not always, but
Explain
they have to.
accredited and non-accredited and when it's required.
So if you are accredited, first of all, usually people are qualified as accredited in two ways. One is either their net worth, which is $1 million of net worth, so taking liabilities out, excluding their primary residence. Otherwise, all of us in California who own a home are automatically accredited. So $1 million of net worth, excluding your primary residence, or by income, which is $200,000 a year for the 2 years prior and reasonably expected in the current year, or $300,000 if you want to count your spouse.
And when you're doing that, do you count debt and expenses?
Not in your income.
So you could be really, really poor and be accredited.
You sure could.
In California.
There are flaws in the law.
Yeah.
Yes.
Okay.
And there's
but people hear about that accredited.
Yeah.
What's an accredited investor? And most people don't know what that means. So
That's
thank you
right.
for that.
Yeah, sure.
With that, this PPM, this couple hundred pages with the operating documents and things of that nature, that's customary but not required, right?
So the PPM is not something that the SEC says you have to do this PPM. What the SEC says is you have to disclose to the investors all the information that is relevant to them making a decision.
Mm-hmm.
And the requirements are stricter if there are non-accredited investors, right, than if they're accredited. But you still need to give the risk disclosures. The PPM was born of, okay, this is the vehicle by which we give those disclosures.
Got it.
So technically not required, but very highly advisable.
Got it. And how do they get away with crowdfunding?
So there are different definitions of crowdfunding. 506C is one of the regulations where you're allowed to accept only accredited investors, but you can advertise or generally solicit. Some people refer to that as crowdfunding, right? Because you're telling the masses, hey, come invest in my deal. There's some rules around it, but generally speaking, you can shout it from the rooftops, put a Facebook post out, take out a billboard if you want to, right? So some people call that crowdfunding. Then there is a regulation crowdfunding, Reg CF, which you may have seen, which is a specific way to go raise money. It's different than a Regulation D, like what we usually see, 506B or 506C. It's different than that. There are specific rules around that and restrictions around that. The beauty that people always come to me like, oh my God, I want to do a Reg CF because you can advertise and accept non-accredited investors. There are still limits. You can't take more than 10% of someone's net worth or income if they're not accredited. So you've got to look into that and see, maybe it's only a $5,000 investment. Now you're dealing with a whole lot of investors.
Yeah.
That's a big responsibility. Plus it's more expensive to do.
So there's these online portals that do this, right? And we won't go through naming them. Most people have heard of them if they've looked into this. But you can get very small fragmented investments, and through the investment side of it, as an investor going in there, you're guaranteeing you've got, whatever their qualifications are. Same thing really applies for syndications, right?
Yeah.
As the operating member, you're not verifying that somebody's accredited. You're not going in and pulling their documents. You're having them sign something.
No. If it's a 506C, you actually have to take reasonable steps to verify that they're accredited.
What is that? You're going to ask for tax returns?
No, actually, there are third-party services that I highly recommend you use. One's called Parallel Markets. Another one's called Verify Investor. Almost every single investor portal, which I also recommend you use, like Cashflow Portal is one. What's the other one that people use? Syndication Pro is another one. That's not my favorite. Cashflow Portal I like.
Okay.
InvestNext, that's another one that people use a lot. Anyway, those are all affiliated with an accreditation service. And so that is considered a safe harbor, like a reasonable inquiry.
So it's a third-party service that an investor signs up for. It supplies whatever documents or connection to documents so that they verify it, and then that portal is guaranteeing that you're working with an accredited investor.
Yeah, not a guarantee, but at least it protects you as the person selling the securities that you did the reasonable steps to verify.
Okay, but that's not required, is it?
It is if it's if you've advertised the deal and you're only allowed to take accredited, then it is required.
If you're not, so what constitutes advertising? If you post it on your socials, is that advertising?
Yeah, it is.
Interesting.
And general solicitation is one of those. If you generally solicit, you're under 506C. And that's when you have to verify they're accredited. So even if you do an email blast to your pre-existing list, if you don't have a substantial pre-existing relationship with every single person on that list, it is a general solicitation.
Very interesting. So when you're doing syndications, you have to be conscientious about this.
Yeah. One of the first questions I ask is, what's your goal for this syndication, and who are your potential investors? How are you going to reach them? That helps me determine where you are, what exemption we need to live under.
Because I've done investments personally where I'm signing same thing saying I'm accredited, but
under 506B, where you're allowed to accept non-accredited but sophisticated investors, you can actually take people's word for it. It's a check the box self-verification. That's okay. But that person then should not have generally solicited, meaning you should have had a pretty close personal relationship with the person who asked you to invest.
Yeah, and I think that's why I asked about social.
Yeah.
Because along with maybe a personal introduction or what have you, they're posting on socials. So definitely riding a fine line there.
Yeah.
Are you familiar with the SAFE document?
Yes. We don't really do that much.
It's a Northern California thing,
Yeah,
right?
yeah.
And it's a tech thing.
Yeah.
What's your opinion of those?
I mean, I've never seen a client do it in real estate. I guess there's a time and place. I've only really ever seen it done in the tech side.
Yeah, I think it's primarily focused on that. In one-page document, really. And no PPM, or at least none required, no disclosures. No.
We're dealing with a crowd, though, in the real estate space that's not quite as sophisticated in a lot of ways.
Yeah.
And I would not recommend it because you don't just want anybody's money.
Yeah.
You really don't. And that, easy in the beginning, tougher later on if you've lost money.
Okay. What's the problem with just taking anybody's money?
I'd say if you're considering joining the AmeriFund team, it's a really good idea.
We as processors at AmeriFund Home Loans support the loan officers in every aspect of the loan once it comes into processing because we want them out there marketing themselves and originating more loans and supporting more borrowers.
Competitive commission plans are a given, and powerful technology is expected, but what truly sets us apart is our culture. We've built a solid support system for our loan officers. If you're interested in joining the AmeriFund team, go to amerifund.com/careers.
Oh, God. I actually tell people due diligence on your investors, same as you would on your partners.
Okay.
Same as you would on your property. Diligence cannot be overstated,
Right.
the importance of diligence. I have been in situations or seen situations, rather, where...
Tell us a story specifically.
Okay. We had a client who just needed the money, right? They just needed money, and anybody who was willing to give them money, they took. And it was one of those things where the investors were like, I just know you and trust you and love you. Here. Run, if, by the way, never just take someone's money because they know you and love you and trust you, because you lose money and all of a sudden that's gone, right? Mm-hmm. So they accepted money from these people, and then times get tough, right? You miss a couple of distributions, or you've got to, God forbid, you do a capital call and have to go ask for more money from these investors. And all of a sudden it's like, you didn't tell me that I could lose my money. You didn't tell me that there was a risk here. I trusted you.
Yep.
I trusted you. And now you're dealing with that on top of a property that's maybe not going so great right now. And it's coming at you from all sides. Those are going to be your biggest pain in the ass investors. It's not worth it.
It's stress.
It's stress, and it's
Very
unneeded
stressful.
stress. You could, and I wouldn't say, and I'm not even putting it on the investor,
Yeah.
like, oh, don't take money from unsophisticated people. I mean, don't take money from unsophisticated people. I really think that we should allow people who aren't yet accredited to invest, because I think it's a way for them to create wealth, and I think it's kind of shitty that we stack the rules against people creating wealth. That's my own political thing.
Isn't
Whatever.
that really? But isn't that what crowdfunding is really designed to do?
Yeah, it is. But that said, you still need to do diligence. And I'm not saying, oh, everybody has to always be accredited. It's easier and safer sometimes, but that's not what I'm saying. I'm saying do your diligence to just make sure that your communication style is compatible. Mm-hmm. They want to hear from you the way you want to communicate and vice versa. Mm-hmm. Make sure that they have the same risk tolerance that you're offering. Make sure that this is a suitable investment for what their stated goals are.
Yeah.
So if they're not accredited, even if they are, you should do this. But if they're not accredited, you really should already understand, like, they're older, they're looking to preserve their wealth or protect their wealth. They're not looking for some big swings that's a little riskier. Maybe your deal's not the best fit.
Yeah.
Right? You should know that when you take their money.
That's what financial advisors do. They
Yeah.
want to make sure that you've, that your investments are aligned with your goals and your risk tolerance.
And that every issuer, mom and pop or W-2, like what if you're just dabbling or whatever, you're selling securities, you have an obligation to these people.
What's a capital call?
A capital call is when you need to supplement the money beyond what you thought the original raise was going to cover for whatever reason. It could be the bank reserves are a little higher now. It could be that there was a fire and you've got to, figure it out. It could be that cash is down because occupancy is low, whatever. But you need more money. And you go back. One of the ways to get that is you go back to your investors and go, okay, we said we we're going to raise $3 million. We actually need $4 million. You guys need to pony up your fair share, or you could get diluted.
Right. And so it's the general partner, the operating partner, that is going back to the investors and saying, we need more money.
Yeah.
The investors don't have to give them more money, but they present it in a way where it's to their benefit to do that because of dilution. What is dilution?
So dilution basically is the pie gets bigger, but your piece didn't. So relative to the whole pie now, your piece seems smaller.
Yeah.
That's basically what it is.
So if you made an investment, and let's say that investment at the time you did it equated to 5% of the overall investment, that was your percentage share at the time of investment, and more capital has to be raised, and they come from the outside, it would dilute your investment into something smaller than 5%.
Right. Yeah. So now you own 3 or 2% or whatever.
Right. So
Yeah.
now that's a smaller return. It's a smaller exit return, et cetera.
Right.
Right.
That's
So
right.
being conscientious of that. So that's great. Let's see. Of your so many achievements that you've had so far, what's next for you?
Well, actually, my book comes out in February, The Power of OPE, but I will be launching a fund to acquire additional resort properties because my retirement goal is to travel the world to beautiful locations, to properties that I own a piece of, I'll syndicate it, that I own a piece of, to do retreats, to teach people how to create wealth in a meaningful
Love
way.
it.
And so I will be buying, I'll actually be buying the Mariposa, which is our boutique hotel that we bought into that fund.
Okay.
And then looking at other properties around the world. We're looking at a ranch in Southern California. It's going to be pretty sweet. And then I'd like a castle in France and you name it. So just luxury resort properties that we can just have amazing retreats at with awesome people.
What's your timeline for that?
We should be launching it Q1 of 25.
I might have something for you in Kauai.
Okay.
Yeah,
Yeah.
we'll talk about
Okay.
it offline.
I love it.
Okay.
See, opportunity everywhere.
That's right. That's right. What do you feel about the adage, the old adage, if you want something done right, you do it yourself?
I'm so happy you said this. Did you see, there's a video that I did with Pace
course.
Morby. Okay. So that I think was a lot of, for me, it was my dad. A lot of our dads telling us in our faces, could be anybody, I'm not trying to be sexist. I think it's garbage. I do. Sorry.
Why?
Because you can only go so far by yourself. What's the other adage, which is if you want to go fast, go alone, but if you want to go far, go with other people.
That's right.
Right. And I think you burn yourself out. You don't get places as efficiently as you could if you do it by yourself. I think you need to figure out your lane, and you need to stay in your lane, and you need to trust the people in the other lanes. So you got to pick people you can trust. That's important. Trust the people in the other lanes, and you're all going to get there faster. I tell this story when I'm speaking to people about this, where I was a swimmer in high school. Not a great swimmer, but I was an okay swimmer in high school. And there's the lane dividers, right? The red and blue lane dividers in the competitive swimming pools. And they're there to keep you in your lane, physically keep you in your lane, right? And there were times when I was a backstroker. I was kind of hugging the lane to make sure that I was where I needed to be, right? And that slows you down. When you're even hugging the lane at all, you're getting slowed down, and it's hard. It hurts sometimes, whatever. If you're really comfortable in your race, you can stay right in the middle of your lane without obstruction, without getting slowed down by even hugging the lane lines, and you can run or swim the fastest race possible by staying in that lane.
Yeah.
And you can't be up looking around at what the other people are doing, or you're going to slow yourself down.
Yeah.
Right? So that is, I think, how business works too, right? And so you get your 100 yards, whatever, done faster, staying right in the middle, staying in that lane, and letting the other people do their thing. If you go across the lane dividers, you eventually could still get 100 yards under your belt. You could, but you're going to piss everybody in every other lane off, and now none of you can win.
Yeah.
So that's why I think
it really brings us all the way back to the beginning of the conversation, which was surround yourself with people that are better at the things that you're not so great at.
That's right.
And if you do that, it's powerful. It's exponentially powerful.
Yes.
So really great lesson. Bethany, this has been awesome. I mean, I've learned a lot.
Thank you.
If people want to get a hold of you, if they're interested in your community, they want to find the book when it comes out in January, or they just need somebody to help them with their SEC syndication, how can they reach you?
All the fun stuff is on Instagram. Bethany _LaFlam on Instagram.
Perfect.
You can get everywhere from there.
Perfect. Well,
Yeah.
you will be in good hands. Trust me. I've been on the receiving end of these documents you've created, and you've done a great job. Once again, thank you for joining us on The Blueprint. If we brought you value and you'd like to share this, that would be appreciated. Like, follow, etc. And we will see you next time on the next episode of The Blueprint.